It's June 6, 2019, and my name is Alejandro Zambrano, Chief Market Strategist with ATFX in London. Let me just make sure that we are live. Um, if you have any questions, just put them in the chat box. Don't be afraid to say hello as well. And if you're new to this, don't forget to subscribe to the videos as well. Everybody, like them. If you're new to this, my name is Alejandro Zambrano, and I've been trading the market since 2006, but I got involved in the forex industry and already in 2005. And I traded many different systems, short-term, long-term, scalping. Tried to sort of research. I have a master's degree and a bachelor's degree in economics and study statistics and things like that. So I've done quite a lot of research on what works and doesn't work with the markets. So hopefully I can help you guys with your trading with the help of my experience. Now what we're going to do over the next 10-15 minutes is I'm going to provide you guys with a general overview of the major currency pairs plus stock markets, commodities and as well, and see if there's anything interesting happening. Now we're going to begin with something which is the euro versus the USD. And the market yesterday traded upwards, which made perfect sense. Had some bad data from the US. In fact, the ADP report showed that the US economy in May created 27,000 new jobs versus about 180,000 projected and about 200 and something in the prior month. It could be an outliner. It probably is some sort of an outliner. But if it's true, then it's a very bad number. And what's interesting as well with the ADP numbers, that the numbers from the ADP, they're not as volatile as the non-farm payrolls. The non-farm payrolls can be 21 month, and then they're like 200 or 300 the second month. It's much more random, that number. But the ADP number, if you look at the standard deviation of that, I think it's about half of the size of the NFPs. So I think even if there's some sort of revision, maybe they'll bump it up to 80K, maybe even 100K. Obviously 100K, still relatively low. And this week on Friday we have the non-farm payrolls as well. And the non-farm payrolls were 20K, I think 3 months ago. So 20K, and that probably had to do again with the shutdown of the US government. And again, if we have a very bad number this year, or this Friday, see another 20 or 50, then it's not a coincidence anymore. It's something that could potentially sort of be the beginning of a deterioration of the labor market. However, though, let's not be too pessimistic. If you look at the initial jobless claims, which is the weekly indicator, so far what I've seen is that it's relatively stable. So it doesn't look that bad, but it's definitely a warning sign. And then, as you know as well, we'll be having some soft data from the US, the market PMIs, and also more importantly, the introduction of tariffs on China imports, which is going to cost the US consumer more and hurt the global economy. So from that perspective, maybe if we have deterioration in the economic conditions in the US, which we're already seeing, we might see maybe a little bit of a push to the upside. But I want to get too excited. But what is interesting is this, that yesterday we said 132.75, 113.75. I said that's, sorry, 113.27. I said that level is important for the market. I said if we trade upwards, we can probably go up, but we didn't go all the way up. We just went up and got rejected. Now what's interesting, you have a nice little high here and then another high here, which means that there's probably, this is what we qualify like a double top more or less. So I would guess that there's a decent amount of stop loss orders just here and here. At the same time, people might actually look to buy on a break here. So this is actually quite good. And then on the lower section, you have a triple bottom. So taking that out can be something interesting. Otherwise, we're sort of within, and until we break these levels, guys, we're within this falling wedge. Now, these falling wedges are usually sort of the end of a move like that, and you could have potentially a bullish move. But we need to be open and realistic, and we could potentially have a break to the downside. The ECB have their rate meeting today. The last time the market sort of totally ignored the ECB rate meeting, what they're gonna do this time around is just gonna outline most likely the new TLTROs, which is loans to banks in Italy. And I said Italy, yeah, Italy, Spain, and places where usually the banks have issues. But not only, of course, exclusive to them. It's in general the whole euro area. So that's some sort of quantitative easing that's going to be unveiled today, but I don't necessarily think it's going to be a big mover. What's also very interesting is that I just want to show you this, is that this is some truly special time, guys, truly special times, because at least on the daily, the average range right now, average 14-day range, is at low 50 pip. Now, in 2014, that's the last time volatility on a daily basis was this low. And after that, I need to switch on actually. So, actually, I need to do like this. This is the weekly levels now. So this is weekly ATR. So on a weekly basis, the ATR is at about 130 pip. Again, in 2014, when the market was here and this inflection point, volatility started to increase. Otherwise, you see, we need to go back to December 1985, beginning of 1986, to go back to similar episode when volatility was this low in the markets. So if you're dealing with breakouts like I have, as you know, I barely traded the euro dollar over the last year because of the very low volatility, and the way things looking right now, these are rather extreme levels of low volatility. Now the beauty of low volatility is a little bit like after rain you have sunshine. It's the same thing here. After a low volatility episode, you will usually have a high volatility episode, and that I think is probably what is happening and will happen at one point. And I can guarantee that. The only thing I can't guarantee is when we're actually gonna break out here. So we just need to be more patient in general when trading forex. The markets are range bound, and they're probably gonna continue to be range bound for longer. And you just need to be very nimble. It's literally, you grab a few pip and run. That's it, really. As for this falling wedge, obviously it's gonna meet down here in October-ish. Some worst case, we'll be stuck here until October. I think that we'll have a break earlier than that. So we just need to keep our eyes peeled, but not getting too excited until we start to see some movement. And when the euro dollar starts trending, that's I think when you're gonna start to see trends in other markets as well. Now this is the GBP versus the USD, and unfortunately it's also stuck in a massive range between 124.78 and 133.06. Okay, so we're stuck within that range. We did highlight this head and shoulders, this being the head and this being the left, and this being the other one being the right shoulder. So that head and shoulders is still in play, and that suggests we could reach all the way down to 23.75. I still think that makes sense. However, what makes more sense is that we stuck within that range and we reached relatively close to that level. And for now, the trend is bearish below 127.51, which is this level here. But if we take that out, we're probably going to head upwards. And if you look at the 1 hour, we have a small head and shoulders here, with this being the left shoulder and this being the right shoulder, potentially in the making now. And then you have another head down here. So you have a small head and shoulders and big head and shoulders. So if we take that out, we could potentially go upwards, which I think makes sense, because what's happening right now is that the people are in the forex market getting ready for the Fed to cut rates. The rates market have already been pricing in rate cuts. In fact, they're pricing in 2 rate cuts this year before the end of the year, 225 basis points rate cuts. Now the forex market, up until recently, the dollar has been gaining, and gaining against the Aussie dollar, New Zealand dollar, and against the pound. Against the pound because of Brexit, against Australian dollar, New Zealand dollar because they cut interest rates, against the Chinese yuan because as well they cut interest rates over there. But now suddenly things are turning, and what's happening is that the U.S. central bank is converging with the with all the other banks, which makes me think, as I said already yesterday, and I said that before, which makes me think that if we indeed heading into a situation where all banks are cutting bank interest rates, everybody's getting worried about the future, the yen tends to gain. And I highlighted Aussie dollar yen short positions and pound yen short positions over the last few weeks. That worked out fine. And now things are starting to move. As you know, in dollar yen, we don't necessarily have the best quality setup or pattern, but as long as you're below 109.92, this is a downtrend, and we could potentially turn lower from these levels and head down to 107.54. As for gold prices, you're seeing them being bullish. So before I left for holiday and time off, I said a break to 1303.74 is probably gonna open up for a move to the upside. This is as well was the falling wedge, which you know, broke out before we actually reached the termination point. And the reason for this is, is because of lower stock markets, right? In May, when stock markets were at the highest, gold prices were lingering at the lows, and then after that, with stock markets going down, this has started to go upwards. Now, the idea was to buy here and look to book profits up here, and we pretty much reached those levels yesterday. Now we're having a little bit of a retest there, and we have not had a very strong correction. So I think it's fair to maybe keep this maybe up to the high, but then I would definitely look to get out here, unless you're really, really bearish and think, stock markets are going to continue to trade lower. But I think the biggest challenge here is just that up here you have the highs from January last year, the highs as well from July 2016. You have some highs over here as well from March 2014, and some of the highs here from 2013. So you have a collection of very important highs in the same level here, and eventually, yeah, I think we're gonna break upwards, maybe go to 1,600, especially if you have a global turmoil. But we need to trade about 1376. So until that happens, I think we can probably hold on to that long position if you're still holding on to it, maybe to the highs, maybe a little bit higher, but then that's gonna be it. I think it's gonna be difficult after that. If you're looking to get involved, unfortunately it's a bit too late unless you bought yesterday on the dip. They're trying to short and bullish about 13.20. Crude oil prices. So this market as well, we've been bearish here. The market has gone down lower. Now I personally think it's a little bit oversold, and I think it's going to snap back. And I think we should be very careful to short sell at these levels, because the from a big picture perspective, it's a bit like GBP USD is trading sideways within this massive range, and we're starting to reach the lower limits of the range. I don't think we should be buying here and hoping that we're going to go up to 72, because I don't think that's going to happen. I think in fact we can go lower, but we could easily have a sharp correction to 56, 58, and then go lower. But if we're going to stick with the short-term levels, which I know that most of you guys like, then the short-term trend is bearish below 5470, and I think here that the market could potentially roll over here. Okay, S&P. So S&P, if you look at it from a daily chart, we're within this massive range. There's no point getting very excited about stock markets at these levels, as we're closer to the highs, and pretty much far away from the lows. I think here, if I would sort of try to play the range bound section, I would try to buy down here, and if you really wanted to do that, like at 2,600 and things like that, if you believe that it's going to be a mild economic slowdown, and if you think that the US and Chinese governments are going to agree on some sort of a deal, then I would do it down here. I would not get involved here, at least not right now, because right now, at the end of the day, this is a downtrend, right? We had 3 days of bullish price action. From a macro fundamental point of view, the ADP report did not really help too much. If you know, from payrolls this week on Friday, again, it's just going to add to the misery. And we still haven't seen the proper effects of the higher tariffs yet. So I think that will come down on the economic data over the next few months. So from that perspective, I still remain bearish, but I don't want to engage here just yet. If you look at the 1 hour, you see that from May 13th up until May 16th, we had a bit of a bullish trend. the price is creating these higher and higher lows, and we're doing that now as well. So we have a low here, and the market did not pull back enough, so you have a low up here. And I want to see what happens here. I think eventually, as here, we'll stop creating higher and higher lows, and the market will return lower. As for the Nasdaq 100, this is really what you want to focus on if you do want to be bearish. I think we're still dealing with head and shoulders with the head, left, right shoulder, and then you have that neckline here, and that goes through here. And really, if this is a genuinely bearish market, we should not trade much higher than 7375. Here, the correction is strong, but not really as strong as with the S&P 500, which took out several important levels. Finally, German DAX. This is probably the poorest one if you want to short sell, because we're not really dealing here with a proper pattern. I guess you could call this an ascending triangle when the market traded lower, but then it pushed all the way upwards and it reached the sell zone. But again, not the best one. I think here as well, you're probably better off looking to engage, if you want to engage, on the break to something like 11,927, because we need to stop creating these higher and higher lows. And that's pretty much it. So we have Antonio in the chat box. Good morning to you, sir. And we have as well Marvin. Good morning. Thanks for joining. And we have Nilbert. And Nilbert says, I've been struggling to trade. Please, anybody help? So trading is obviously difficult. And I can give you a few tips. Now, if you want to make life easier, I personally think that trade with the bigger time frames. Trade maybe with the daily chart, and sometimes you can use the 4 hour. I use the 4 hour, so I identify the trade setup on the daily, and then use the 4 hour to maybe tweak stop loss orders, and then when the market is going to my advantage, I use something daily 4 hour to determine really where to put stops. Because like 95% of people, probably 99 are forex traders, something like that, they all trade short term. Why? Because if you look online, everybody promotes short term, and there are some benefits. I mean, there's some issues with forex in general, and the biggest problem with forex is that it's not like stock markets that usually just go one way upwards, right? They will give back. They will correct. So you have a position on, you bought at the low, and then you have a pullback, of 50% of the move from the prior day. So there are some, that's just the characteristics of forex market. So if you can manage to actually crack the code and sort of figure out how short-term trading really, really works, then, you want to, then at that point, I think, it's something you can try to do. But the truth is that 73% of people that trade lose money, and a majority of people never really figure out what works. And the biggest problem with the short term is that there's so much noise in the short term. You have news coming out that rocks the market. You have comments, for example, Donald Trump, but sometimes from other central bankers that move the market. So there's much more noise. It's much more difficult to break a level on the daily chart. And usually to break a level on a daily chart, it has to be some genuine moves or genuine reason for the break, which that genuine reason tends to be some sort of fundamental news. So if you want to shorten, I'm saying also shorten, not weeks or months, but shorten the years that it takes to become a profitable trader, and you try the short term, then do try the longer term. That's what I would suggest. Try the longer term. I spent many years doing the short term, and it really didn't really work out. And then at one point I said, okay, I just want to make money here. I don't care how much. I just want to be profitable and consistent. I want to be able to feel confident in what I'm doing. And I switched to the daily, and from there I sort of saw that it actually worked. So from 2014, I'm up on, by the end of December 2018, I was up with about 288%, which is about 10 times, not 10 times. I think this stock market was up with about 50% at the time from 2014. But what's also very interesting is because the benefit of trading when you master it is that it speeds up everything, and it really does help. To give you an idea, the average return on the S&P 500, I think it's about 8.5%. That's the average return over the last 100 years or so. Now, the stock market traders, if they would have, like I was up with 280% by the end of December, and stock market traders, the S&P total return index was up with maybe 50 over that period. Now, if I would have stopped trading in 20 by the end of December, so if I would not have traded, I could have stopped. And for the average trader in the S&P 500, the buy and holder, it would have taken them 10 years for them to catch up with me. 10 years if they would get their average return per year. So that is why I think it's important to stick with the market, stick with trading, because when you have nailed it, when you have a system that works over time, now not all systems are gonna work every month, every week, every year. So working exclusively, just having trading as your full-time income, there's very few people can manage that unless they're trading with big accounts. So if you're trading with really big accounts, if you're trading with 1 million and you do 20% 1 year, that's 200,000. You can live very well with 200,000 pounds. Even in a city like London, you live very well. And if you live outside in the countryside, which a lot of these people do, to keep overheads low, it's terrific. So say you have, all right, say you have 500,000, and you do the same amount, then again, it's some solid money you're dealing with there. So if you have that sort of money, then that's fine. Even if you don't have a winning year, then it doesn't matter, because maybe you have some good money from prior year. But if you're trading with smaller accounts, which most people are, then it's important to have another income, not just to depend on the trading alone. And that's what I can say. So again, if you want to simplify things, if you tried many different things, you're just getting chopped up in the market, just flip to the daily, look for opportunities in the daily. That would automatically reduce the amount of time you trade, and that will also sort of try to keep you in moves that are good. Now, it's not always like I do a breakout breakout strategy, and breakout strategies like the one I use work good on trends. But I just show you the euro dollar is that volatility is as low as it was in 2014 and 1986. So volatility hasn't been this low for about 34, 35 years. So, obviously it's going to be more difficult to using a simple trend following strategy like I'm using now. But again, if we look back at that indicator, at the ATR on the weekly, low volatility conditions tend to be short term. Like here, 2014, the market was going down, but then volatility picked up, and then volatility has now been declining. But most of the time here, like in 2016 up into 2017, so you have about a year or so of very stagnating volatility, but most of the time then it just picks up. A final little tip, with ATFX, I actually done a premium course. So for anybody that opens up an account with ATFX, it doesn't matter on the actual account size, as long as it's a real account. Of course, if you put $50, I'm not even sure you can open with $50. But as long as you, genuinely looking to trade with ATFX, they do offer my premium educational course. It's about 3.5 hours long, where I cover the current trading strategy I'm using. I also cover the basics. That's available. And for people that want to open an edge account, and it's an edge account really what you need, because that's where it's spread so tight. With the edge account, I also get access to coaching with me, and that could also be something. So literally, we get on online, and you can share your screen if you have a strategy. I can share my screen. We can talk markets. And if you want to know more about that, then just send an email to alejandro.zambrano@atfx.com. You can also, if you find it simpler, you can send me a WhatsApp message to the following number as well. If you want to, you can ask me to add you to my distribution list. If you're on my distribution list, I'll send you usually one message a day with this video, sometimes two if there's more activity. Again, if you have any questions, let me know, and hopefully I can guide you and steer you guys in the right direction. Okay, we're gonna wrap things up. Guys, let's take a look here. We got 2 likes still, so not a lot. So guys, don't forget to like the video. It's very straightforward. Just click here, and I'll see you guys tomorrow, same time here at ATFX offices. Thank you very much. Bye-bye.